Few structures are as widely used but as little understood as trust, especially when it comes to the potential tax consequences which can arise when they are misused. A trust is basically a structure which allows a person or a company to hold an asset for the benefit of others. The person who controls the asset is the trustee, and those who benefit are the beneficiaries. The assets held in a trust can vary. Property, shares, businesses, and business premises are all commonly held in trust structures. The creator of the trust, the settlor, sets out the specific rules as to how these assets should be managed in a document called the trust deed. By putting assets in a trust, you don't own the assets in your name. The assets are legally controlled by the trustee. However, you can potentially control exactly how those assets are managed now and in the future. You have the power to set out who receives the income arising from the assets and when they receive it, as well as who receives the underlying capital represented by the assets themselves and when. Discretionary trusts, sometimes known as family trusts, are the most common type of trust used by business owners in Australia. They are generally created to hold a family assets and or businesses so as to protect the assets and to facilitate tax planning for family members. Advantages of the trust. From a tax perspective, the main advantage is that any income generated by the trust from business activities and investments, including capital gains, can be distributed to beneficiaries in lower tax brackets, often spouses and children. Because the trustees of the trust have the discretion to distribute income and capital as they fit, and no beneficiary has a fixed entitlement to receive anything, the trustees are able to distribute income in a tax-effective way on a year-to-year basis. The downside is, to the extent that they don't distribute the income to the trust, the trustees themselves are liable to tax on the undistributed income, at a rate that is usually higher than the beneficiaries themselves would have to pay. In most cases, from an asset protection perspective, assets held in a family trust cannot be attacked by creditors or lawsuits, so they are ideal for protecting assets from businesses or personal disputes, and they can also facilitate the transfer of assets from generation to generation tax-free. Talk to your advisor to see whether it's worthwhile to use a trust for a business or make investments.